Good morning, everyone. Uh, Thank you so
Thank you
much for
so
joining
much
us
for joining
today.
us today.
Before we begin the session, I would like to request everyone to keep themselves on mute and keep their video feed off to maintain the sanity of the session. And as we can see, many people have joined us, and it's 12:05. We would like to begin our session. Uh, Today, we'll be talking about a very interesting topic that is also on a limelight nowadays, which is global investments. And first of all, I would like to welcome everyone for the Financial Pulse 2022, which we have been conducting to communicate, to maintain a communication between our investors so that all the information related to the markets can be passed on to you. I'm very happy to see the improvement in financial technologies and the government regulations. So they has permitted us to invest beyond the geographical boundaries. Today, we will speak on why the US market has been corrected, what is the extent of this correction, how far can the correction go, why the government has barred inflow into global markets, and how are the investment in Edelweiss US Tech Fund getting impacted from it, and what should an investor in global markets do at this stage. We request to everyone, if they have any question, they can post the same in the chat box. We'll take up the session at the end of the session. Today, we have Ms. Shalini Gera as a speaker on global investment topic. She's a certified financial planner. She is a senior partner in Ingenetus. We'll be discussing lots of things about Ms. Shalini on the global investment. Hi, Ms. Shalini.
Hi, good morning, Preeti. Thank you for the introduction. I'll request you to switch on your video feed when you speak so that investors can directly have an idea of who is talking and what are you talking about.
Sure. Actually, it's already
It's
on, I
already
think,
on, I
but due
think,
to
but
some
due to some
internet
internet
connectivity, it's
connectivity,
might be
it
not showing.
might be not showing. All right, sure.
Sure.
So thank you,
So
Preeti, for
thank
that
you,
very
Preeti,
kind
for the very
introduction.
kind introduction. Uh, Thank you.
Thank you.
Welcome. And I, am I audible
Am I
properly?
audible properly? Yes, you're audible. Yes, you're audible.
Great.
Great.
So,
So,
Ms. Shalini,
Ms.
before
Shalini,
we enter
before
into
we
the
enter
detailed
into the
discussion
detailed
on this
discussion on
topic,
this
I would like
topic,
to
I would like
know what do you feel about global
global
investments
investments
as an asset
as an
class,
asset class.
and do you recommend to invest in the same?
So yes, Preeti, we started recommending global investments as an asset class to all of our investors in the year 2020. The idea for
The idea for
introducing this asset
introducing this
class
asset
was
class
never
was
to push returns to the investors, but it was very strategic in nature.
strategic in nature.
So there were
So
three
there were
reasons
three
why we had recommended the global equity as an asset
equity as
class
an
to all
asset
our
class to all our
investors. Investors were
investors. Investors
already
were already
used to
used
Indian
to
equity as well as fixed income. The idea of introducing global equity as an asset class was to put forward
put forward
diversification.
diversification.
So, the first
So
and
the first
foremost reason why we
reason why
introduced
we
global
introduced
equity
global equity
was so that investors could get experience of other stocks which were listed in the US markets, which they could not have access to in the Indian markets. So, while we were all utilizing companies like an Amazon, a Netflix for our over the top requirements. Amazon, we could not work without shopping with. We were utilizing Microsoft as well as Alphabet for our browsing and work from home requirements. It was also possible to start having ownership of these companies in the portfolios. And this was something that we could do via global investing. So that was the first reason. Secondly, this was done for a very strategic reason of putting in geopolitical diversification. Now, imagine a scenario where we have 100% into Indian domestic equities, and suddenly there is a geopolitical factor like a collapse of a local government or an Indo-China trade off, Indo-China face-off that we had 2 years back. Such factors could lead to volatility in the Indian markets, and our Indian markets can become very, very sensitive to such scenarios and correct sharply. So, in such a scenario, if we have 10% of an allocation into global markets, it would ensure that my 10% of the portfolio will remain completely insulated from these local geopolitical factors. The third reason why we offered global portfolios was that we could also benefit from INR depreciation. Now, this is a fun fact that $1 was equivalent to one INR on 15th August 1947 when we gained our independence. Since then, INR has been on a historic decline of about 7% per annum. Now, when we invest in global stocks, we are actually investing in INR, which has been converted into US dollars. So when we finally get the return is actually equivalent to the return of the global stock plus the INR depreciation factor, and then you get a net returns. Hence, you are actually benefiting from the INR depreciation by investing into global stocks. Fourth and finally, this was not a reason for investing, but obviously it benefited the investors. From a long term perspective, US markets have always performed better than the Indian markets. I'd like to actually show investors a data point over here. Just sharing my
Yeah,
screen.
that would be very helpful.
So, Preeti, are you able to see the market dashboard?
I can see that your screen is presenting, but I cannot see the dashboard.
All right, let me just try doing that once again.
We can see the
Yes, now I
dashboard.
can.
You can see the dashboard. All
Now
right,
we can see the dashboard.
presenting it once again. So this is the market dashboard as of May 10th. If you see the returns of the first row, which represents S&P BSE Sensex, so that's our Indian benchmark. So you can see the 3-year returns have been at a 13.2% and the 5-year returns have been at a 12.4%. Similarly, when you look at the world equity indices, the returns of US Nasdaq Composite Index are seen. Nasdaq is the broader index of the US market. The 3-year returns have been at a 14%, 1% higher than 3 years. And the 5-year returns have been again at a 14%, another 2% higher than the Indian markets. Now, this is in spite of the fact that US markets have actually corrected by 17 odd percent in this year itself, in spite of the fact that US markets and Indian markets have had the same sort of correction. In spite of that, we are able to see higher returns in the US market, even from a long term perspective. So, in an average market, the US markets are able to deliver 4 to 5% kind of an alpha above the Indian market. So, this sort of a return differential always benefits your portfolios.
Perfect. So thanks for the insight, Ms. Shalini. A small follow-up question on that. For a conservative investor and for an aggressive investor, what percentage you would suggest to have allocation into global investments?
We ideally recommend 10% of an allocation in the global markets. For a
Okay.
conservative investor, this can be less than 10%, 5 to 10% of an allocation is good. For an
Okay.
aggressive investor, this percentage can even go as high as a 20%. More than 20%, we should not be having into global markets.
Perfect. Thank you so much for that insight. Now, I would like to request you to brief our investor on the US markets and why they have been corrected significantly.
Right. So, three factors which have been responsible for the steep hike that the US markets have seen. First of all, US inflation figures have just come out. A couple of days back, we saw the US inflation data come out at 8.3%, and this is the highest figure in the past 40 years. So, in order to combat this high inflation, Fed quickly stepped into the picture and increased the rates by 50 basis points, which was a very, very high. Now, it's just not this hike which has led to the correction. It is the pace of the hike which has led to the correction. So the hike was actually taken on a little bit later than what it should have been, and the pace of the hike was very quick. So instead of a 25 basis points, we saw the rates being hiked by 50 basis points in one single go. What is the impact of this rate hike? So whenever there is a rate hike, the working capital cost of companies tend to increase. When there's a working capital increase, it leads to a reduction in the profitability, reduction in the corporate earnings, and hence naturally a reduction in the stock prices, and hence you can see the correction in the equity markets in US at this point of time. That's just the first reason of it. Secondly, when you look at the bond yields have also been rising. I'd like to show you the data of the US bond yields over here.
Sure.
You again able to see the market dashboard.
Yes, we
All
can.
right. So if you look at the fag end of the fixed income markets, you can see that the 10-year government bond yield were at a 1.35% 1 year back. They have been sharply increased to a 2.99% currently, and just about a week back they were at 2.97%. Naturally, when fixed income returns or fixed income yields are at a high, it causes investors to look other than the equity markets. It naturally leads to a redemption pressure on the equity markets and causes investors to flock to fixed income markets in the hope of better returns. And hence, again, pressure on the US equity markets and returns being transferred or cash inflows being transferred to the fixed income markets. The third reason for this kind of a correction is the Russian Ukraine crisis and also China lockdown. So, both of these factors have led to fractured supply chains. We don't have goods and commodities available to us the way they were being made available to us a few years prior. And then, hence, this fracturing of supply chain also causes negative impact on the equity market due to a negative sentiment. So, these three were the reasons why the US markets have corrected the way they did.
Great. My follow-up question would be to similar to this question. About by how much the US market has been corrected as of now?
So US markets can broadly be categorized into two to three benchmarks that most of us tend to know. The most common benchmark is Nasdaq Composite. Another benchmark is S&P 500, and the benchmark that we follow with respect to our Edelweiss US Technology Equity Fund of Fund is Russell 1000. I'll talk about the collection all of these indices. So S&P 500, which talks about the first largest 500 companies in the US market, has corrected by 13% just in the month of April. And overall, it has corrected by 17% YTD from January till now. If you look
Right.
at the Nasdaq Composite, which is higher in terms of the technology companies, that has corrected by a steep 27% so far this year. But if investors look at their US tech holdings in their portfolios, which is closely represented by the benchmark Russell 1000, that has had the maximum impact to the extent of 30% of the correction. So, most of the US technology stocks have overall corrected by 30% YTD.
Right. Right. Thanks for this insight. So we have seen multiple correction in the markets since inception. Sometimes the market rebound quickly, and in other cases, it may take years to rebound. What do you think? How far this correction would go?
That's an interesting question. Very, very difficult to predict how long are we going to see this pain, but we certainly have technical indicators to understand what is the extent of this correction. Again, let's go to some historical data. I'll be sharing my screen.
Sure.
Hmm. Can you see the graph on my screen?
Yes, we can see the graph.
So this is basically the drawdown or the negative performance of S&P 500 in the history from 1948 till about 2010. So all of these graphs represents the time when US market was in a recession. If you look at the average of all of these figures, you'll realize that the markets on an average have corrected by 27%. And the maximum correction that has been seen was in 2015. That was to the extent of 240 days. Now, if you look at the current correction in S&P 500, that is only to the extent of 17%, and that has only been there from January till now, which is about 130 days. So, if I have to look at an average, I can sense that the S&P 500 index will correct by another 10 odd percent to the extent of 27%. And since it has only been corrected to the extent of 130 days, it can last for another 3 to 4 months longer. So overall, we can expect on an average of 27% correction in this index, and the
Hmm.
correction to last for another 3 to 4 months.
3 to 4 months further. If there are facts which rates hike, another rate hike, it may go beyond 3 to 4 months, right? Based on the market changes.
Entirely possible, Preeti. We've
Entirely.
just looked
Yeah.
at an average and given a sense to the investors how long this could last.
Right. So, moving forward, Ms. Shalini, as we all are aware that for international investments, industry-wise limit is being breached. Hence, we are unable to do any kind of further investment globally as of now. So, can you please brief our investor why has the government barred this inflow into the global markets?
See, the last 2 years since we started recommending Edelweiss US Technology Equity Fund of Fund has have been extremely interesting for the Indian investors, because we were exposed to another asset class, global equity, which we did not know about, or which we could not invest in till now.
True,
So
right.
in the past 2 years, Indians have started seeing global investments as an exotic investments. Everybody wanted to hold a Tesla, a Twitter, an Uber, an Alphabet, and Microsoft in their portfolio. So the pace at which we started seeing outflows from the Indian markets into the US markets was immense. And this led to a sharp fall in our currency. Naturally, when we are demanding US dollars and we are selling our INR currency starts to depreciate very quickly. And the pace at which this was happening was a little too much for the RBI to digest. RBI did not want our currency to depreciate so quickly. So it quickly stepped into the picture and put an embargo into any further outflows that were happening from INR to US dollar. Now, every industry has its own limit of how much INR can be pushed into the US markets, and this industry-wise limit from for the mutual fund industry was $7 billion for our active investments, and this limit was quickly breached in the past 2 years. So that is why we've had an embargo on any future outflows into the US markets. However, no further lump sum investments can be made. But as far as the existing SIPs are concerned, existing SIPs continue to be honored. Investments in passive funds also continue to be monitored, and that's how it is. Once the pace is controlled, the window is likely to be reopened once again.
Oh, great. I hope this will be a good news for to our investors. There's one fund that we have been recommending to our clients, which you have also mentioned while we were in the conversation. Edelweiss US Tech Equity Fund of Fund. So, can you please brief all the investor what is the impact of the US market correction and this restriction of government uh, will have on this particular fund?
So, two separate questions over here. First of all, the impact of the correction in the markets on US technology fund.
Right.
We have already seen that Russell 1000 index has corrected to the extent of 30%. I'm sure investors can also see this in their portfolio and feel the pain of having US markets in our portfolios. I'm seeing a lot of investors put up concerns as to why are we still in this portfolio. So let's talk about that. First of all, let's understand the rationale as to why the US stocks have corrected the way they had. So, as I mentioned earlier, the pace of the rate hike has been very, very high and very steep, more than what it should have been, and that's led to a sharp correction in the US stock market. Now, when you look at the tech stocks tend to be corrected the most in a inflationary scenario, in a rate hike scenario. Now, why is it so? Because the valuations of technology stocks are basis the future cash flows. Now, as far as the future cash market is concerned, we are looking at an increasing trajectory in the rate hikes, and hence corrected valuation for IT technology stocks. So more than other stocks, IT technology stocks have taken a beating as far as their stock prices are concerned, and higher correction in these technology stocks. The second factor that we look at is high technology valuations in the past 2 years. Now, when we had massive inflows into the US markets in the past 2 years, the technology stocks performed the most. When they performed the most, they had reached a peak valuation or extremely high valuation, and hence a correction in these valuations was warranted. This correction is something that we are seeing right now. This is actually a very healthy correction because it gives investor an entry point at lower NAVs. It gives investors the opportunity to generate higher returns by entering into the stock market at a lower NAV and booking the profits once they reach at a high once again. As far as the correction is concerned, the correction has been to the extent of 30% YTD. So very, very attractive points to for the investors to continue their SIP and to capture lower NAVs. Your second question was on the government restriction as to how is it impacting. So as far as any new lump sum investors are concerned, any new investor will not be able to put in new SIPs or additional lump sum into the US markets at the moment from an active fund perspective. However, whatever existing SIPs are there, those existing SIPs continue to be honored by the Indian entity. And investors, if they see their account statement of Edelweiss US Technology Equity Fund of Fund, they'll still see that they are getting the advantage of the lower NAVs at these corrected stock prices.
Great. That is very nice. So that even though there is a limitation of outflow in globally, but still they are getting the lower NAV as an investment. So that's a very interesting thing. My last and most important question would be, what should an investor in global markets do at this stage?
Hmm. So when I interact with the investors, I see a pain. I see a lot of pain by having investing their hard-earned money into the global markets and seeing that corrected by 30%. There
Mhm.
are a few recommendations that I would like to give to investors at this stage. The first and foremost thing that they should not be doing is redemptions in US technology or in global markets at this stage. Why? Because if you redeem at this stage, you book a loss, which is actually just a notional loss on the picture. It is only a loss on the papers, it is not an actual loss. But the moment you redeem, you actually cause that loss to become realized and then it hits your accounts. So do not redeem whatever investments you have made. Stay invested and give the chance to recover. Secondly, what you should not be doing is seizing your existing SIPs. Whatever existing SIPs are going are continuing to be honored by the Indian entity of the fund in which you are investing, especially in the case of Edelweiss US Technology Equity Fund of Fund. So when you are investing into your SIPs, you are getting the advantage of lower NAVs. So do not stop your SIPs. If you stop your SIPs in global markets, in the US markets at this stage, we do not know when and if there will be a chance to re enter. I would also like to show you certain additional data points over here in terms of timing. So I hear this from a lot of investors that let's stop our SIPs, let's give them a chance in the Indian equity markets, and whenever the US markets recover, let's start the SIPs. And we should not be doing so because the window for investments for new investors in the US markets is currently closed off, and hence we do not know when and if you would be able to put back investments in the US market. And hence, please don't try to time the market. So let me show you an interesting data point over here for people who try to time the market. Hmm. Preeti, can you see the window?
Yes, we can see the window.
Edelweiss Equity US Technology Fund. These are the returns of S&P 500 companies in the US market in the past 10 years. Data points from 2002 to 2020 to 20 years actually. Uh, this is about timing the market. So investors who feel that they should exit the market because the markets are vastly corrected and they don't want to see negative returns in the portfolio and they want to re-enter the markets whenever there is a recovery. So for those people, see, investors who remain invested throughout, that is before a correction, during a correction, and after a correction, made an average of 7% return in these S&P 500 companies. Investors who exited when the market was at a low and then tried to re-enter, if they missed just 10 good or the 10 best days, the recovery had reduced profits to the extent of 3.5%. If the investors missed this points of the market as well as the highest points of the market, इसलिए timing की कोशिश मत करिए. It's better to actually remain invest in the markets and continue to generate the profits. Facts have correctly displayed as to what is the advantage of staying invested throughout. And then there's this another data point that I would like to show you, which is about the US, specifically about the US technology returns. So these are the returns or the performance chart of Edelweiss US Technology Equity Fund of Fund. See, YTD and the past 1 year has been negative, but this is equity. We explained to all of the investors in the beginning that this is an equity asset class, and equity equity asset class is going to be volatile in the short run. So if you want to enter into this fund, have a broad horizon beyond 3 to 5 years. You should always have a long term horizon for any sort of an equity mutual fund. Now, if you book this fund at a loss, you are redeeming the losses and you're also losing out on the opportunity for the fund to recover. So if you look at the calendar year returns between 2012 till 2021, you'll realize that whenever there has been a correction in terms of the returns in the equity markets, the correction or the lower returns have immediately been followed by better returns, much better returns, much better than the Indian equity market. So, for example, 2012 markets had corrected and investors made only 8.5% return. Immediately after in 2013, investors were able to generate a 29% return. Similarly, have a look at the year 2016. Investors made only 6% profit in this fund. But in 2017, investors were able to generate a 47% profit. So, this is the idea of staying invested in a low market as well, that you get the opportunity for the fund to recover the losses and to generate higher profits. This is what we assume is also going to happen in the current year and the next year. If you are facing losses at this point of time, um, it is estimated that the fund will recover to a higher extent within the next year. So these were the two data points that I wanted to give you from the Edelweiss US Tech perspective, Preeti.
Uh, Beautifully answered, and these facts were really helpful, I think, for the investor to stay invested on this particular investments. Apart from all this, Ms. Shali, I would like to know, as an advisor, what is the importance of staying invested if money is not needed? Not booking the profit in mutual funds, because many of the investor have shared this concern with us ki whenever there was a profit in the portfolio, why should we not book the profit and reinvest it? So here I would like to understand from your point of view, what is the importance of staying invested?
We always advise individuals to start their investments basis for their financial goals. So any
Right.
financial goal which is from a short term perspective, from a 1 to 3 year perspective, should ideally not be put into the equity market. And any financial goal beyond a 3 to 5 year perspective should ideally not be put into the equity market. Because if you are moved out from equity by booking the profits, and if I moved into a debt asset class, or into my savings account, I was subjecting my investments into a 2.5% for a 2.5% return if I was there in the savings account, or if I moved into the fixed income asset class or fixed deposits, I was subjecting my investments into only a 5% return. On the
Right.
other hand, if I continue to stay invested in the equity markets for a long term, the annualized returns that we have been able to generate in equity historically have been 15% and beyond. So by not coming out of the equity markets, by not booking the profits, I was in a position to not pay off an exit load. Remember, whenever you come out of investments from your mutual funds or even your stocks, you have to pay an exit load or you have to pay brokerage charges. Secondly, whenever you book the profits and come out of equity markets, you are also paying a capital gain, short term capital gain or long term capital gain. And then finally, you are subjecting your investments to lower returns in the form of fixed income instruments. So remember, it is not just about booking the profits and coming into an asset class, you are also paying multiple transaction charges. And all of these transaction charges can ultimately eat into the returns of your original asset class.
Right. That was very helpful answer. Thank you so much, Shali, for sharing all the information,
Preeti, I'm
sharing all
losing
the
your
facts
voice.
and figures with us. Very needed at such point. And hello, am I audible now,
Yes,
Nishani?
Preeti, you're audible
Better?
now.
Better? Great. So I was just extending my thanks towards you for sharing all the information and facts and figures with the clients and briefing on the US market, especially because that was a pain point to all of our investors. If they have any kind of question or query, they can reach out to us. query they would like to raise, they can put them in the chat box, or they can unmute themselves and ask directly also. We are open for the questions. Vishali, till then, questions from the participants comes up. I would like to raise a question from an investor who couldn't join the session. It is the same question as which we have already taken up, but he wanted to know that is it possible, like same question, is it possible in any way to invest further, like in global investment, is any way ki near future mein windows can be open for investments? What can be the reason that allow government to open that window for investments? How long does they have to wait for that?
We don't know what is the extent of this window being closed off. What we do understand is that the government has stepped into the picture in order to reduce the overall reduction in the pace of our currency. So, because INR was flowing out into the US markets at a very high pace, we saw INR being corrected very, very largely, and it has moved to the extent of one US dollar being equivalent to 77 INR at the moment. So government could not digest the slackening of our currency to this extent, and hence it immediately had to step into the picture and shut the window. Right now, we have crossed the limit of $7 billion of investments being made in the mutual fund industry into the US markets, and hence this window has been shut off. The conjecture is that it may be open in the next 6 months, but then this is only the conjecture of us who are working in the asset management company industry. The ultimate decision lies on RBI as to when this window will be reopened. If investors are still looking at entering into the US markets at this stage, they do have certain avenues. Those windows are still open in the form of passive funds, so investors can invest into global ETFs, and there are certain additional funds that are also open in order to invest into the US markets. If investors are interested, they can connect to us on an individual basis, and basis their asset allocation as well as risk appetite, we can recommend these funds to them.
Perfect. Thanks for your response on that. Participants, we have not seen any question in the chat box. I would request if you guys have any questions, any query that you would like to ask, we are open for the questions.
Investors have absolutely no questions with respect to the global indices. It either means that they're absolutely convinced on being invested in the global markets, or it's vice versa. They're not at all convinced. So, investors, either ways, if you have any queries on the global markets, do let us know.
Hi,
If you think
hi, Salini. Sorry, I joined a bit late to your, this talk. So I just wanted to ask few things. So what is your view for the, short-term duration, seeing all the market scenario for the current situation? So how you are thinking? What is your outlook for the short term and long term for the both domestic and the global market?
अच्छा so I'll answer first of all with respect to the global markets. The global markets में जो अभी correction हुई है लोग, that is to the extent of only 17 odd percent if we are looking at S&P and Nasdaq. S&P has corrected by 17%, Nasdaq has corrected by 27%, and the index that we follow, that is Russell 1000 for the technology stocks, that has corrected to the extent of 30%. Now, if you look at the historical data of US markets since 1950, there has been an average correction to the extent of 27%, because the overall benchmark, which is S&P, has only corrected to the extent of 20%. We are looking at an additional 7% kind of a correction. S&P 500 is corrected to the extent of 17%. Hence, we think another 10% of a correction will not be unwarranted. So that is the extent of the correction. And if you are asking me about the short term outlook, uh, the maximum correction in the US markets has been to the extent of 267 days, so, which is little more than 7 8 months. Right now, we have seen the correction not last beyond 130 days, only from January to May. Hence, we can look at this correction to extend in the short term uh, for another 3 to 4 months to the extent of total 27% of a correction. So that's your short term outlook on it. As far as the long term outlook is concerned, historically, US markets have always performed better than the Indian markets. And the reason is very, very simple, that the larger technology giants in the world are based out of USA. So you look at the market leaders, if it's a Tesla or if it's an Alphabet or Microsoft, all of these companies are based out of the US. They have been able to offer better than other corporate earnings. If you compare the corporate earnings of US technology companies versus emerging market technology companies, US technology companies have always offered higher corporate earnings and always offered higher stock price returns. So that's the outlook of it. From a long term perspective, it makes a lot of sense to have global portfolios in our asset allocation, as a part of our asset allocation. From a 3 point perspective: one, they offer us the exposure to US based stocks; two, they give us the factor of INR depreciation as well; and three, they also offer us geopolitical diversification. So from a 3 to 5 year kind of a perspective, from a long term perspective, it makes sense to have US stocks or global stocks in our portfolio for the above three mentioned reasons. And the returns have also been justified. US markets have largely offered a 5 to 7% alpha over the Indian markets. That's your answer on the global perspective. If I look at the Indian economy, again, a very, very high amount of pain that investors have suffered. We've seen Sensex correct from a high of 62,000 in October 2021 to a low of 52,000 as of yesterday. We are talking about a 16 to 17% extent of a correction. The extent of the correction has largely been on the backing of high amount of FII outflows, because Indian markets have seen a high amount of valuation, and then FII investors were looking for cheaper markets. They thought, hey, India is a largely overvalued market, and let's look at other cheaper markets. They are also there. So let's start pulling out of the Indian market. So we saw a lot of FII outflows. Last month only took about 7,000 crores out of the Indian markets from the FIIs back to the global markets. Apart from that, our inflation figures came into the picture. So we saw a 7.79% inflation figure in April 2022. The government estimates were to the extent of only 6%, and we were largely on the upper band of that, and hence the government had to immediately react. In order to hike the rates, they extended repo rate by 40 basis points from 4% to 4.4%. CRR was hiked by another 50 basis points. On the back of this hike in the rates, we saw steep correction in the stock markets. So difficult to say how long this correction will last, but we don't think that this volatility is going to last, or this volatility is going to end within this year. I think we still have some more pain to bear in terms of our returns, and all of these corrections should be looked as opportunities in order to invest further into the stock market or into good quality mutual funds, because we are utilizing their lower NAVs as an entry point. So from a long term perspective, from a 3 to 5 years and beyond perspective, equity beats any other asset class, and it makes a lot of sense to have equity in our portfolio if our risk appetite and our financial goals permit so.
Yeah, thanks, Salini. That was really helpful.
One question I have received, Ms. Shalini, for you. So, as a text, so there is one investor who wants to know, he attended some webinar and we got to know that these the correction which are we have been seeing is the correction, but this is not the bearish market. Do you agree with that?
Hmm. Bearish market typically means 20% plus correction. So since Sensex has only corrected by 17% in the Indian markets, uh, technically we have not yet reached a bearish market. If the correction goes beyond 20%, we'll see a bear run. And even in the US markets, if you just look at the S&P 500 returns, they are still at a minus 17%, and hence technically not a bearish market in US either.
Thank you for your response, Ms. Shalini. That was helpful. Uh, Participant, any further questions that you would like to ask? I think, ma'am, from this session, as you were mentioning, that it can be either of the case. First, either they are satisfied with what of all the information that we have shared, or it can be vice versa.
Yeah. Yeah, Preeti,
So,
may I ask a question?
sure, Mr. Bhatia.
Yeah, very good afternoon, ma'am. I'm Nishchay. I'm
Hi, Nish.
rather a, I'm rather a very new investor. It's been barely about 20 days, and the pain you've been talking about has been endured quite well by me. So I'll ask you the million-dollar question: that what timelines are we looking that the market is going to move towards the plus side from here on? How much time we have keep enduring this pain for? I'm talking
So,
about as concerned with this seminar was for the global market, but I'm the question is based for the Indian market and the Indian equity market.
Sinishchay, it is very difficult to predict. We are no astrologers how much this volatility will last. The past 2 years have seen a bull run. You have not invested in the past 2 years, but the past 2 years was so fantastic for the equity markets that everybody decided to come in. Every single investor, whether or not they had knowledge on the stock markets, they decided to step in, and they made a lot of returns as well. This was largely on the backing of the FII inflows that we were getting in our Indian markets. Indian markets have beaten not just global markets, but they have also beaten other emerging markets in terms of the returns, in terms of the BRIC nation. They've beaten Brazil, Russia. Russia has no standing now. They've beaten a China. They've also beaten a South Africa. Now, in the past 2 years, because there was so much of investments in the Indian markets, we saw very high valuations for every single stock, whether the company was doing well or not. It saw an increase in its valuation. It saw an increase in its stock prices, and even bad companies were able to deliver some amount of returns to the investors. When we reached that sort of a high, we reached an approximate uh, market cap to GDP ratio of 120%. And this market cap to GDP ratio is nothing but it indicates the valuation of a
Yeah,
country stock market. Now, this valuation has corrected to the extent of 103%. If you ask me how long this is expected, my sense is investors are not likely to generate very high sort of returns in at least this year. So this pain and this volatility could last to this year. uh, Investors should always enter into the equity market from a long term perspective. So if you have the horizon of anything between 1 to 3 years, equity markets are not for you, then you should be looking at the debt side of the markets. However, if you have an outlook beyond 5 years, if your financial goals permit you to remain invested for more than 5 years, then equity markets are the right horizon. Beyond a 5 year sort of a time, there is no other asset class which has yielded better returns than equity. Whether it's fixed deposit, savings account, gold, real estate, no other asset class has given you as much returns as equity does. Overall, from a long-term perspective, we expect the equity markets to deliver 15% plus annualized returns to you.
yeah. Thanks, Shalini.
Thanks, Shalini, ma'am. We have received a question from in the chat box. I think she's a newly investor. So she has asked that how to deal with these kind of correction in the market. Like indirectly, she want to ask what does an investor do whenever she or he see a red in their portfolio.
Right. See, the the most common investors or the most common behavior of an individual whenever they see red in their portfolio is to panic, and it is to withdraw from those investments. What happens if you withdraw from an investment whenever there is a negative return is that you book the losses. You actually book the losses which are only on paper at that sort of time, which is why we recommend to stay invested even during negative times in your portfolios. So whenever there is a negative return on your portfolio, or whenever you are seeing red all around you in your portfolios, that is actually the time that you should capture those opportunities and you should invest in the market. History has observed and displayed that people have made more money by investing in uncertain times, uh, as compared to when they have invested in certain or bull runs. So more returns were generated by investors whenever they invested during a corrected scenario. So you should take up all of these opportunities which are presented by the stock markets whenever they correct heavily. For example, right now Sensex has corrected by a 16%, small caps have corrected by a 20% as well. You should actually take up all of these opportunities to invest more. Invest not completely, but invest in tranches. So whenever you see a 5% odd correction happening in a few days, invest a certain tranche of your liquidity available. Whenever there is a further correction, more than a 5% correction happening again in the equity markets, invest another tranche, and so on and so forth. This way you are not exposing the entire liquidity that you have to a particular point in the stock market, but you are entering at lower prices and getting an average of that.
Nice. Uh, Thank you so much for the answer, Ms. Shalini. I think we have covered all the question, almost all the question that we have received. So I think we can see any further question from the participant that we can take.
Preeti, I think the investors have already asked all of the questions that they had to.
Yes, right.
We also continue to engage with all of our investors on their individual financial planning sessions, answering these questions in US markets. We'll wrap up the session over here. Thank you so much, investors, for putting in your participation over here, as well as putting in the questions. It was wonderful speaking to you. We'll continue to interact with you on a monthly basis on our Financial Pulse webinars. Till then, stay safe, stay healthy. Signing off. Take care and bye.
Thank you, Ms. Shalini. Thank you, participant, for joining. Have a good day.